Notice how this CNBC report doesn't give any details on who exactly is on the working group.
We have an exclusive interview right now with Securities and Exchange Commission Chairman Christopher Cox, who is a member of the President's Working Group. Sir, thank you so much for joining us.
Happy to be with you, Melissa.
Not a lot of teeth in what we've seen so far. Was that the point of the group, or we were kind of expecting to see, more regulation or ideas about regulation?
Well, as you know, the Securities and Exchange Commission, for example, has pending regulations directed at hedge fund issues, but the President's Working Group is an umbrella group comprising the Treasury, the Fed, the SEC, and the Commodity Futures Trading Commission. So it can't directly issue regulations, but what we have done is issue a set of principles that we think will permit each of our respective departments and agencies to be more forward-leaning, because we are very focused on issues of systemic risk and investor protection in this very fast-growing market of what we've referred to as private pools of capital, encompassing not only hedge funds, but also private equity and venture capital.
So what should our takeaway point be in reading what you wrote?
It's been since 1999 that the President's Working Group looked at this issue, and of course a lot has happened in the marketplace in the intervening 8 years. As a matter of fact, given the growth of hedge funds and the fact that this private pools of capital industry is relatively opaque from the standpoint of government policymaking and regulation, it's a focus not only of the United States, but our counterpart regulators overseas. And we are working very, very closely, not only among federal financial agencies, but also with our international counterparts, with other governments around the world.
But Chairman Cox, hedge funds move fast. The government inherently moves slow. Do you have any hope of trying to regulate this industry?
Well, I think you put your finger on it. That's why market discipline is so vitally important. We have responsibility, for example, at the Securities and Exchange Commission for regulating brokers, and the provision of brokerage and the provision of credit to private pools of capital is an important source of discipline to make sure that we have well-functioning markets, investor protection, elimination to the maximum extent possible of systemic risk, the objectives that we're all seeking here.
But aren't hedge funds part of a well-run market? I mean, don't they seek out, inefficient markets and arbitrage? I mean, isn't that the whole point of it?
Indeed, it's important to point out that notwithstanding their size and notwithstanding the concern that if we don't know what's going on, something might be amiss, there's a lot of liquidity being provided. There are a lot of important functions in the marketplace being provided by well-run hedge fund operations and private pools of capital generally. So what we want is to maximize the beneficial potential of private pools of capital, make sure that information is provided to investors in these private pools in accordance with sound principles, and minimize any downside. In particular, look after that investor protection piece, which is so important to us at the SEC.
Well, speaking of investor protection, I mean, what about the blow up at Amaranth? Do you feel like, more regulation or more government could have done something about that?
Well, the President's Working Group has focused in some detail on an after-action review of that very situation, and there's good news and there's bad news there. Of course, the most significant bad news is all the money that was lost and all the things that went wrong. But the good news is that the system dealt very well with that, and we are looking to find out how some of that was built in and how some of it was good fortune. We want to make sure that we benefit from that experience.
Do you think there's been a lot of talk about raising the minimum net worth that a person must have in order to invest in hedge funds? Do you think that's important, or, does the investor know what he's doing?
Well, investors obviously know what they're doing. They look after their own interests. It's important that they have the tools with which to do so. I think there's been a fair amount of misunderstanding of what we're after at the SEC when it comes to that suitability requirement. What we are focused on.
So what do you think? Should we raise the minimum to $2.5 million from $1 million?
Yes, I do indeed believe that. We have a proposed rule out to that effect. It is an inflation adjustment based on an existing rule, so it essentially is maintenance of the status quo to that extent. But the more important point to make here is that retail investors can and should be able to buy hedge fund interests or anything else, but any security sold in the United States of America under our laws and rules has to provide basic disclosure. And only if someone who's offering a security wants to be exempt from those disclosure rules do these other suitability requirements kick in. But if one wants to make a public offering of securities or even a private offering with suitable disclosure, there isn't any reason that they can't sell to retail investors without respect to these minimum investment and minimum, I should say, minimum asset requirements.
All right. Thank you so much, SEC Chairman Christopher Cox. Thanks for joining us.